Thank you for downloading another episode of Your Life Simplified. My name is Brian Leitner, and I'll be the host of this episode. And in this episode, it's a little bit different than some of our previous episodes because today I have two guests, and they are here to discuss answer questions that we've received from some of our listeners. And frankly, they're all a little all over the place, and I think it touches a variety of different aspects within wealth management. So I'm excited for the topics, excited to hear from our listeners, and very excited to have our two guests on the show here today. And our first guest is Pat Kummer, who runs our Highlands Ranch office. So Pat, thanks for being on the show today.
Thank you, Brian.
And I'm joined by George Fernandez, who runs our practice management team out of the Kansas City office. So George, thank you for being here.
It's great to be here.
And George, you're a recurring guest, so we won't spend much time on your background. We'll shortchange you a little bit.
Okay.
But Pat, if you could spend maybe just a couple of minutes talking about who you are and what you do, I think it'd be helpful for our listeners.
Brian, thanks for having me here. I think it's really important to offer these educational forums for people. And quite frankly, that's how I started my business. I wanted to provide education to people who actually really needed advice. So I started a practice for this purpose. And 33 years ago, I started working and teaching and writing about financial literacy, mostly through the Financial Planning Association, and then, of course, through my own practice with my clients. So overall, my goal was really to empower people to have enough information so that they could make good decisions. So I think this is a great opportunity to provide and continue that education through these podcasts. So I appreciate the invitation today, Brian, and I know we have a lot of great topics to cover.
So Pat, thanks for being on. Very impressive background, and love the fact of what you've done over your career as it relates to financial literacy, because frankly, there's not enough that's done, especially at some of the younger ages in our school system. So appreciate what you do and how you do it. So having said that, again, no particular order. The first question that came in, and I'll paraphrase this a little bit, has to do with taxes. And a lot of us know that there was a tax law change a couple of years ago, and I think people are still trying to figure out what that means to them and how they can position to take advantage of some of these changes. So one of the questions that came in is, based on the new tax law, I'm no longer going to itemize. And I think a lot of us know that based on the increase in the standard deduction, few people relative to everyone that's out there are now itemizing. And the challenge is they're talking about the fact that they no longer have a charitable deduction opportunity, yet they're still going to support that charity and organization and that cause. So is there a way for them to reap the benefits from a tax perspective, even though that they're not itemizing and therefore may not qualify for that tax deduction on a go-forward basis?
Well, you're exactly right, Brian. I think that has been challenging for charities as well. And there are many ways to do it. In fact, I'll just highlight three simple things that people can keep in mind. And the overarching goal here is that people do their planning early in the year so that you have more opportunities. The first one, of course, is if you're over 70 and a half and have to take required minimum distributions, then of course you can use the qualified charitable distribution up to $100,000 can go directly to a charity from your IRA. So that is nice. It stays off the itemized portion of your tax return, and you just don't have to pay taxes on that amount. The second one is been around forever, and that is just consider giving appreciated assets. Whether it's stocks or mutual funds that have a very low cost basis and you don't want to pay the capital gains on that, you can gift that asset directly to a charity. And that's something that's been around for a while, but we might have forgotten about it with the ease of itemizing in the past. And then the third item is become more popular now with the tax law change, and that is bunching deductions. And so what that means is every other year, you categorize all of your deductions, whether it's medical or charitable, and you do that, and property tax, and you do that in January and again in December, and you itemize that year, and then the following year you just take the standard deduction. So those are three simple items that people could take advantage of.
Great ideas. One of the things that comes to my mind when it comes to bunching, what I've been hearing a lot of people do is taking those large charitable contributions they would normally make throughout the year and bunching those, as you just said, at the end of the year or sometime in that year, and putting that into what's called a donor advised fund. And what's really intriguing about that concept, about using a donor advised fund, is it allows you to get the same level of deduction as you would as if you gifted that cash or appreciated asset directly to the charity, but you don't have to distribute it out to the charity right away. So that's been one of the challenges I think a lot of people have had with bunching, is that when they think of bunching, it's like, well, I don't know if I want to give that charity all of that all at once. And so are there other options? And using a donor advised fund actually allows you to capitalize on that bunching approach, because you can put that $10, $15, $20,000 or whatever in there for those 2 years, and then you can actually distribute it out to your charity the following year at whatever increments or whatever frequency that you want. So it really adds a really great layer of flexibility to that approach of bunching.
So guys, those are great thoughts. And while there may be strategies that we see on a regular basis, let me just cover those briefly so everyone really understands and we hit this home. So the QCD, the qualified charitable deduction, that's for folks that are over the age of 70 and a half. And really what they're able to do is sort of taking up what we refer to in the tax world as almost an above the line deduction. So this is funds that are coming directly from their IRA, and you're giving them, you're not actually taking receipt of that. It's going to the cause itself. It's going to the church. It's going to the temple. It's going to the Red Cross directly. And then they don't have to recognize that as income, yet it qualifies the requirements, or it satisfies the requirement of the RMD. So for those folks that are charitably inclined, that have to take the RMD, that's a great option. Obviously, appreciated assets. I know statistically speaking, most people still donate cash. They give it right to the, again, church or university or so forth. And those aren't generally the best assets. So Pat's point to appreciated assets, and if you can qualify for the deduction from that perspective, I think that makes a lot of sense. And then, of course, bunching. What's really interesting about that point is I think a lot of folks, they're not proactive as it relates to their taxes. And so whatever I did last year, I'll do the following year and the following year. But what you guys are talking about is really interesting in that it's every year is a little bit different. And so maybe I can work with my tax professional, my wealth advisor, to make sure that every single year I'm being methodical and strategic about what option I'm going to take. And so again, we're talking about bunching deductions, which is simply taking a step back and saying, in this year I'll bunch it, I'll create a deduction that enables me now to itemize, because that number is going to be a greater deduction than the standard deduction. But because I did that, maybe in the following year, I'm going to take the standard deduction. And maybe every other year or whatever that looks like. And again, everyone's tax situation is very fluid. Excellent points, guys. Really, really do appreciate that.
Brian, one more point on that is really common with property taxes, because you get your property tax bill in advance. And so you could pay your property tax in January and again in December for the coming up year and take two property tax deductions in the same year.
That's an excellent point and an excellent transition. So I appreciate you going there, because our next question from someone who emailed us, they were talking about, their house, and they were asking, they said, look, again, I don't itemize anymore. So from a SALT deduction, state and local taxes and mortgage interest and so forth, should I pay off my mortgage at this point? What does that look like? And again, just so all of our listeners know this, everyone's situation is obviously a little bit different, but maybe some general advice on what you see, Pat.
Well, of course, we love to have tax deductions on everything, but sometimes it's not always about the tax. I think in this case, Brian, it's actually more about what are the interest rates that we're dealing with. What is the interest rate on the mortgage versus what are you earning on the investments, where you might have to take money out of a good performing investment to actually raise the capital to pay off the mortgage. So we have this question a lot in our office, and we see people coming in that have really nice low mortgage rates, 3.5%, maybe even 4%, and they want to take money out of an investment that could be earning 5.5 or 6%. So sometimes it's just simple math that says this doesn't make sense with or without the tax deduction. I think it's more of a financial planning question about how does this fit in with my monthly income, with my expenses, and overall, how does this impact my nest egg if it could be growing at a higher rate of return?
Yeah, I think that's a great point. And like we always talk about, don't let the tax tail wag the dog either, right? I mean, we're all trying, no one really likes to pay taxes, but at the same time, what is the bigger picture? And if the bigger picture is, and your goal is to grow your wealth, it depends on the rates. Just like you said, it may not be the best, may be interesting from a tax opportunity, but when you look at everything in its entirety, it may not make sense. And having said that, again, I go back to what your goal is. If your goal is to build wealth, that's one thing. But there's also a personal preference, right? I mean, are you comfortable at this age having a mortgage? And how do you feel about that? And, it always goes back to, are you comfortable? Are you sleeping well at night? What are you worried about? And I think that the behavioral finance side of this business is absolutely critical because, again, it's not all about the numbers.
Yeah, and kind of along this line of taxes, I think you guys raised a really good point. I want to refer our listeners back to a previous podcast that we had on tax, and we had our tax specialist here at Mariner talk about this and the importance of looking at tax planning versus just tax preparation. You mentioned and kind of alluded to this just a few minutes ago about the power of knowing where you're headed at the beginning of the year, and then versus at the end of the year when you always typically plan for your taxes, or planning on an annual basis, but planning on a multi-year basis. And I think both of you kind of hit on the importance of looking at planning, tax planning, just like you do your wealth planning engagement. It's a multi-year project, and you want to look at all the options that you have over the next several years, not just this calendar year.
Great points. So for our next question, it says here, I'm turning 65 next year. This individual is going to continue working. And so their question is, do they need to sign up for Medicare? Do they stay on their company's plan? What advice do you guys have for this individual?
Well, absolutely. We want people to take advantage of any possible help they can get with healthcare these days. So we encourage people to sign up for Medicare. And actually, if you go onto the Medicare.gov website, there's a lot of good information out there about why you need to sign up within a certain window, or there could be penalties. And some of the penalties actually last for the rest of your life. So I think people want to be very careful about this. You actually have a 7-month window, 3 months prior to your birthday month and 3 months after that, where you can register. If you don't, then that you could incur some penalties. I think we have more and more people these days that are working past age 65. So it does kind of come into a kind of a strategy around, gee, I don't want to give up my medical benefits through my employer, and maybe they're better. So it's definitely worth a conversation with your company's HR department to find out if you can stay on the major medical plan. But at the same time, you do need to enroll at least for Part A and Part B on the Medicare program. And now there's also penalties on the Part D, which is the prescription drug program. So again, probably way too much information to go into in a podcast, but I want all the listeners to be aware that this is something that they need to do. Of course, if they're signed up for Social Security already, then some of this would happen automatically. But as I said earlier, we have more and more people who are still working, and one of the strategies around financial planning might be to actually delay your Social Security benefits, in which case you'd actually have to remember to purposefully go out there and register yourselves for Medicare in time.
Yeah, some really great points, and I think the key there, and I think you said this, which is that it's important when you are turning 65, if you are going to continue to work, talk to your human resource department. I'll give you an example. I have a client that I work with, and she turned 70 this year. And when she turned 65, she told me that her employer still offered her health insurance benefits. She worked for a very large employer here in the Midwest. And I said, let's talk to your HR department, because we need to understand, are they going to let you keep that health insurance, or are they going to require you to be on Medicare? And so in her particular situation, she actually substituted her health plan for Medicare. So she got a waiver at that point in time to sign up for Medicare. So she's still on Part A, but she did get the waiver for Part B. So she doesn't have to sign up for Medicare Part B until she actually retires, which is going to be this year at age 70. And so, but the important factor there is we had to talk to the HR department first, because some plans actually coordinate with Medicare. As you pointed out, you may have to still sign up for Part A and Part B depending upon what your plan is. And you don't want to miss that, because if you do, then you're right. You'll have those penalties that'll last the rest of your life. So it's really important to stay in touch with what your HR department is doing.
Yeah, I think that, again, these are big decisions. And to Pat's point, the penalty for this will last the rest of their lives. And so it's that whole idea of measure twice, cut once. I mean,
yeah, exactly.
Make sure you're coordinating this with your wealth advisor or your tax advisor, as well as what goes on at your own individual employer.
Yeah. So can I add just one real quick thing on that? And this is kind of, on the podcast. And just so one of the responsibilities that I have here with you, Brian, is to actually produce podcasts. And so I would be really interested if, as Pat mentioned, this is kind of a hard thing to cover in this topic today, But if you're interested in hearing more about this and maybe would want to hear a podcast on Social Security and Medicare, let us know, and then we can certainly do one dedicated on that particular topic.
Yeah, it's a great point. Speaking of Medicare and transitioning a little bit to maybe its sister, Social Security and Social Security filing strategies. And, I would tell you that, just a few years ago, and even frankly today, there are a lot of people that they ask their friends and family about, when they should take Social Security. And, I think the joke is, well, get your hands on the money as soon as you can. And, I think the rules have changed to some degree, right? There's been a change in the laws of the past couple of years. And so, the question this individual is asking is, can I still take advantage of Social Security filing strategies, or is that done? Is that ship sailed? You guys have thoughts on that?
Yes, the famous file and suspend that a lot of people, by the time they figured out that there was actually a great way to take advantage of that, then of course that loophole was closed. There are still some strategies that are available. And again, I would encourage people to do some serious retirement planning around this subject. I think people sometimes think that retiring and collecting Social Security are a single event. We do a lot of teaching around this subject that they're not a single event. You can retire and you can actually collect Social Security at a different time. In fact, maybe that even might be a good part of your strategy, especially with the ability to see your Social Security benefits increasing all the way up to age 70. There is still one little strategy available called filing a restricted application. That's available for people born before January 2nd of 1954, in which case, if you're married, you can actually file a restricted application restricting your benefits to your spouses or a portion of your spouses. So in other words, I'm not filing under my own, I'm going to file under my husband's, and then I'll come back later and collect under my own. And so that little strategy kind of feels like double dipping, which again might be one of the reasons that Social Security is not going to be allowing it for people born after 1954. But it is still something that people should be aware of and should be included in their overall retirement projections about how best to utilize what the Social Security benefits are.
So, Pat, excellent point. Would you walk us through maybe a basic example so people understand maybe what that advantage might look like to them for those individuals that are born prior to 54?
Yeah, so we just had a situation that actually just last week, we had a couple who actually retired at 63. She collected Social Security under her own benefit, which was relatively small. It was about $800 a month. And he delayed his Social Security benefit. In fact, he's going to be delaying all the way up to age 70. But because he was born prior to that magic date of January 2nd, 1954, he is eligible to go and collect a restricted benefit under his wife. So he's able to get half of his wife's benefit, all the while his own benefit remains untouched, and that he can continue to have his grow over time and then come back at age 70 and collect. He's going to collect about a $3,000 benefit by waiting.
Absolutely terrific. And so again, he's benefiting off of her benefit for a period of time, all the while that he's holding off until age 70. And of course, as he waits from his full retirement age to the age of 70, his annual benefit is increasing by an 8% annual guaranteed rate of return, of which I don't know another investment that's going to yield that same 8% guarantee. So excellent points. It's a great question. And frankly, one that I still don't think many people pay attention to.
The spouse's benefit is unaffected. I think they feel like, that there's going to be a deduction somewhere. And to understand that in this case, the spouse that collected early, her benefit is not affected in any way by doing this.
Yeah, it's great. I all the time, I hear all too often, it's, well, as soon as I qualify, at age 62, I'm going to get my benefit. Because the reality is I don't know when I'm going to die, and I want to make sure I get the maximum use. And, from the studies I've seen, from folks I've worked with, the reality is a lot of people, there are health issues that are out there, there's no doubt. And if somebody has a situation, it's a completely different ballgame. But on average, they should be more focused on how do I get the most over my entire life? And generally speaking, for healthier individuals and so forth, just delaying can make a whole lot of sense, again, looking at their situation in its entirety.
Hey, this is Scott Sturgeon. I work on the team that makes Your Life Simplified a reality. We'd love to have more information on our listeners so we can ensure that we are tailoring content to what you're interested in. For the next several episodes, we are going to give away a pair of Apple AirPods. Being considered for the giveaway is easy. Simply email your age, state you live in, and 3 topics you'd like us to address in the future to podcast@marinerwealthadvisors.com. We will pick a winner at random during the next several episodes from those who email us. Again, email your age, state you live in, and 3 future topics to podcast@marinerwealthadvisors.com. And now, back to the show.
Okay, so a few more questions here. We have one on life insurance, and there's an individual, they suddenly have a need for life insurance, but they have a pre-existing condition. So obviously that's going to make the process for shopping for life insurance a little bit more difficult. Do they still have any options with the pre-existing conditions? Pat, any thought on this one?
Well, first of all, proper insurance coverage is extremely important. And so I think as part of the financial plan, everybody should be reviewing, what would happen to their family in the event of a death or a disability or anything that, you might need help with other resources to fill in. The advisor can certainly work with the insurance specialists and even speak with underwriters in advance to determine if the pre-existing condition would cause there to be any kind of a rate increase or even a denial in coverage. And Brian, it's really important that they do this in advance of taking the application, because what we don't want is there to be something on the client's permanent record that says they were rated or denied. You want to know what that information is in advance before you actually go through the formal application process. But yes, there are many situations, depending on what it is, where the insurance company will consider providing some type of coverage for that person. So I think it's definitely worth checking out. First and foremost, I think we need to look at the financial plan, though, and understand what the proper amount of coverage is. A lot of folks come in and say, oh, I had $1 million worth of life insurance and it's going to expire, therefore I must need $1 million worth of life insurance. And what we find is through different life stages that maybe that's not necessary anymore. So let's identify the proper amount first, and then let's go to work and find the right insurance carriers that will look into that.
Great points.
Yeah, all great points. So for me personally, it was an interesting story in that I was approached, put together life insurance for my family, and I made a choice not to. And then I was diagnosed with a condition. And so at that point, I was then getting insurance, and so then I was rated. And so to your point, it put it on my permanent record. And so that affected my premiums that I paid. The fact that I had a pre-existing condition, however, didn't preclude me from actually getting insurance, but it did change the way in which I had to approach insurance going forward. And to your point, Pat, one of the things that I think is so important today that people, and I just want to reinforce this, and that is talk to an insurance specialist, because it is very, very simple to take your condition, explain it to the specialist, have them look at the firms or look at the companies that they work with to determine which ones right for that and which ones don't, which ones you can look at, which ones you can avoid. And so they go through the process of just a very light underwriting, as you pointed out, and can make all the difference in the world of being able to get insurance or being continually rated. In my situation, I found that I could get insurance and I was no longer rated because I was treated for it and it's been controlled. And so now there are actually possibilities for me, even though I have a pre-existing condition, that I can actually get life insurance without having to be rated on it. And so, but you have to shop that. If you don't shop it, then you could find yourself just continually paying those higher premiums.
So George, appreciate you sharing that. Maybe just a couple of quick thoughts, as it relates to how much life insurance you need, working with specialists. Obviously, I'm a little bit biased, but again, when you look at your situation in entirety, I think it's best to sit down with a wealth advisor first, someone who understands the entire picture, rather than just working, in a silo, if you will, with an insurance expert, because they may not know the entire situation. You really do want to work with a fiduciary, making sure that someone is looking at this within your best interest. So I think that's important. The other thing I would mention that, I don't think people think about this way, but I'll say it this way. We think about assets like our house, stocks, bonds. Another asset may be your health. And you may be able to leverage that as part of your overall financial situation, depending on what your goals are. And so this question, this listener, they're thinking to themselves, well, maybe I was going to get the insurance. Now I have this pre-existing condition. Whether someone needs life insurance or not, that's up to them, their own personal situation, and working with their advisor. But obviously the benefit of getting insurance at a younger age, and even potentially getting more insurance that they need perhaps in the beginning, knowing that they can always reduce that down the line, may lead to a variety of different advantages and strategies that they may have should they potentially develop something down the line and they end up with a potential problem. So that's just something else to think about. Everyone's situation, again, is a little bit different, but appreciate you guys sharing that.
That's a great point. I actually work with a client, and the strategy we use is that we did go a little bit higher on the insurance because there were things that they knew they were going to be planning on for their life, kids and college and all that stuff that wasn't where they were then. And that was for that reason, because we know what their health is today. Yeah. We don't know where it's going to be 10 years, exactly. 15, 20 years down the road.
There's just too many stories.
Exactly.
So the next question that we received was on investments. And obviously, as of the time of this recording, the market's done well, right? Measured by the S&P, we're up almost 20% year to date here. The question is, should I expect that, maybe a 10% rate of return from the market every year as I look at my own projections and my own financial plan? What are your thoughts on that?
Well, of course, it would be lovely to expect that. What I think might be more beneficial is that we actually create a financial plan that's sustainable at more realistic levels. And then, you have a better feeling that you're going to have your feet on solid ground going into retirement in particular. I think what people hear about the 10% return is maybe a very long-term statistic historically. It doesn't mean it's going to happen every single year. And of course, anything could change. But going forward, you can really expect the market to pretty much mirror whatever's going on in the economy and in the world. And so people need to probably pay attention to, what the current affairs are before they start, tagging some artificial number to their calculations. Obviously, if times are good and corporate earnings are up and interest rates are low, among other things, that could certainly play a role in pushing markets higher, which is what you've talked about happening so far this year, Brian. But at the same time, we could have an economy that's going into a slump, or we could have a lot of unrest worldwide, in which case, of course, markets do pull back and can even go into negative territory. So I think, again, that, working with your financial advisor to build the right kind of portfolio for your particular goals in particular and your time frame just would be more realistic. And people should compare their returns to their own financial plan, not some benchmark or what your neighbor thinks is important. I think a well-diversified portfolio shouldn't be 100% in any single market anyway. So if you're going to have, a variety of different asset classes in your portfolio, then you can't just tag it to one benchmark like the S&P 500. So we would encourage people to consider a more sustainable return for their basic planning needs. And then if you get higher returns, then you are ahead of the game, right? It's like a little bit of a bonus.
Pat, I think that's spot on. I couldn't agree more. In addition to that, the question itself, he's presenting or she's presenting a very linear rate of return, right? I'm going to get maybe 10% or 8% or whatever the number is, but I'm going to get that year after year after the year. And I think we all know the markets don't work out that way. And, we're in the process of recording another podcast as it relates to sequence of returns and the impact certainly on distributions and what that looks like in someone's portfolio. And so I know that your team, our wealth advisors across the country are very focused on stress testing the portfolio. Linear is great, but just truly understanding from a randomized rates of returns, interest rates, given different scenarios, running thousands of assumptions to model something and really stress test, hey, am I going to be on track and am I going to be okay? Because taking that next step without truly going through that process, I think would be nerve-wracking for anybody.
Right. And would you rather have your financial plan say, oh, yes, I'm going to get 10% the first year I'm retired, and if the market's down 30% that year, then what do? Go back to work? I don't think that's necessarily a good answer either. So obviously nice long historical rates of return, like you said, Brian, that's linear. But in reality, there is a big impact to what your overall nest egg would look like based on these sequence of returns. If the year you retire happens to be, we happen to be in a recession, then you're going to have a totally different outlook in how your assets are growing than you would if it was a very positive year, for example. So that stress testing is something that we use in our office every hour of every day, because it does a good job of explaining to people that, we don't really expect to be able to predict the markets, number one, and we certainly can't predict what year certain things are going to happen either.
Well, Pat, as we begin to wrap up the show, we ask every guest that we have the same question. It's humbling. And that question is, what is the worst financial decision you've ever made?
Oh, I think I've had a lot. I don't know if how any of mine are unique compared to anything else your listeners have heard already or not. I mean, my first house was at an interest rate of 11 7/8%. So, and of course, you don't have enough money in your early 20s to be putting lump sums of money down against your mortgage. So I won't bore you with all the housing things. I have to generally say, though, that I was remiss in not getting help from a tax standpoint very, very early on. I really resisted working with a CPA for some reason. And now in hindsight, I have absolutely no idea why I did that, except I was certified in tax and thought I knew everything and could do everything for myself. But I would say it's very hard to be your own independent advisor, whether it's for financial planning or investments, or in my particular case, from a tax standpoint. I think I missed out on opportunities for Roth conversions early on. I'm a big believer in tax planning and tax strategies. We do a lot of that for our clients on a regular basis, but I think I'm guilty of the shoemaker's kids with no shoes, in that I neglected to take my own advice along the way.
So I appreciate you sharing that, and that's humbling. It's great for all of us to know and heed that advice. As a side note, I happen to be friends with a psychiatrist, and the psychiatrist told me that most psychiatrists that he know have their own psychiatrist that they go and see, right? So similar from that perspective, regardless of what working with someone and someone being that advocate for you and helping figure out what's important, the best way to get there, I think makes a lot of sense regardless on the industry. So Pat, thanks again for the show. We greatly appreciate the advice. And hopefully if, again, listeners have more questions, I want to hear about additional topics, they can go ahead and feel free to email us at podcasts@marinerwealthadvisors.com. So George, Pat, thanks again for being on the show today.
Good to be here. Thanks, Brian.
Thank you, Brian.
We know that your time is incredibly valuable, and we hope you find this podcast a worthwhile investment of your time. Thank you for listening.
Mariner LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor. Registration of an investment advisor does not apply certain level of skill or training. MWA and its representatives are in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in a state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. Visit www.marinerwealthadvisors.com for additional disclosures. Mariner LLC, doing business as Mariner Wealth Advisors, will be giving one pair of Apple AirPods per episode to Your Life Simplified following the initial run date of this commercial, provided that there are submissions to choose from. Winners will be selected randomly. Each winner will be emailed to notify of the award and will be asked to provide a mailing address to mail the prize. The email address submitted will be subscribed to Mariner Wealth Advisors communications, including, but not limited to, our newsletters and email campaigns.